In this video, you'll learn 8 interesting things about bonds you simply must know. As you saw in the last video, stocks and index funds are your wealth-building tools and will likely be the lion's share of your holdings. But remember how we talked about hedging against the ups and downs of the market? That's where bonds come in. They're not just for making a bit of extra income, they're also your shield against deflation. Now, here's the thing about bonds. They're a bit of a mystery to most folks. The risks, the benefits, there's a lot under the surface that you need to know. So, if you've ever wondered what else is there to bonds that you might be missing, then you are at the right place. In today's video, I'm going to walk you through 8 eye-opening facts about bonds that you really should know. Before we get into it, please give this video a thumbs up for that YouTube algorithm. Now let's get into it. Number 8, bonds offer protection from deflation. There are 2 main risks to your money: deflation and inflation. Deflation happens when prices of goods drop downward, and inflation happens when prices go up. We protect our money from the effects of inflation by investing in stocks. Bonds, on the other hand, offer a steadier path for our investments to grow, compared to stocks since they aren't as likely to fluctuate a lot in value. In addition, some bonds come with tax benefits. For instance, the interest from municipal bonds is tax-free at the federal level and often at the state level too. Similarly, U.S. Treasury bonds are also free from state and local taxes. If you've ever wondered what is the difference between bonds and stocks, well, here's your answer. When you buy stocks, you are essentially buying a piece of a company, whereas with bonds, you are essentially lending money to a company or government. When prices drop, aka deflation, the money you get back from a loan can buy more things than when you lent it. This helps balance out the losses from deflation on your other investments. During inflation, prices go up and the money owed to you becomes less valuable. When you receive repayment, your cash can buy fewer things. That's why it's smarter to have assets, such as stocks, which increase in value along with inflation. Number 7, bonds perform better under index funds. Those who own their bonds through index funds such as Vanguard's Total Bond Index Fund enjoy massive protection from the risks that are part of the market. All bonds invested in the index funds are top quality, which means they have a lower default risk. In addition, index funds tend to hold bonds of widely differing maturity dates, which protects them from interest rate risk and inflation. If you are going to hold bonds, holding them in an index fund is the way to go. Very few individual investors tend to buy individual bonds, with U.S. Treasuries being the main exception, along with bank CDs, which act like bonds. Number 6, bonds come with a lot of risk. Bonds have 2 main parts: the interest rate and the term. The interest rate is basically what the borrower, the bond issuer, promises to pay the lender, you or the fund you own. The term is simply the length of time the money is being lent. So if you were to buy a $2,000 bond at a 10% interest rate with a 10-year term from a company, each year, the company would pay you $200 in interest over the life of the bond. If you hold on to the bond for the 10-year period, when it reaches its maturity date, the bond issuer is obligated to pay back your original $1,000 investment. You see, bonds are relatively safe. The biggest risk with them is whether the company you invested in defaults and does not pay you back. The first risk with bonds is the risk of defaulting. Rating agencies evaluate creditworthiness to assess how risky a company or government bond is. They use a scale from AAA, the least risky, to D, the most risky. If the rating is lower, the risk will remain higher. With higher risk, it becomes tougher to find buyers for your bonds. And when it's harder to find buyers, you must offer higher interest rates to attract them. Investors want higher interest when they take on more risk. Therefore, default risk is the initial factor that decides the amount of interest your bond will yield. As a bond buyer, the more risk you're willing to take, the greater the interest you will receive. Number 5, bonds come with a higher interest rate risk. The second risk, linked to bonds, is interest rate risk, connected to the bond's term. This risk becomes relevant only if you decide to sell your bond before its term ends, on the maturity date. Here's why. When you decide to sell your bond, you must offer it to buyers on what's known as the secondary market. Using the example we have just seen, these buyers might offer more than or less than the $2,000 you paid. It relies on the direction of interest rate changes since your purchase. If rates have risen, the value of your bond would have dropped. If rates have fallen, the value of your bond would have increased. Look at it this way. You paid $2,000 to a company and are earning 10%, which is $200 per year. Now, let's assume interest rates have risen to 15% and I have $2,000 to invest. Since I can buy a bond that will pay me $300 every year, clearly I'm not going to choose your 10% interest bond. Thankfully, the secondary bond market, where bonds are traded after their initial issuance, can determine the precise market price of your bond based on the current interest rate. You might not like the price, but at least you will be able to sell. However, if interest rates drop, the context changes. If instead of 10% it falls to 5%, my $2,000 will only buy me a bond paying $100 per year. And since yours pays $200, clearly it's worth more. Number 4, bonds take longer to mature. As you have likely guessed, the maturity period of a bond is another crucial risk factor determining the interest rate paid. If you decide to sell, the bond market will determine the price. When interest rates increase, bond prices decrease. Conversely, when interest rates decrease, bond prices increase. In both scenarios, if you hold a bond until its term ends and there's no default, you will receive exactly what you initially paid for it. While each bond is priced separately, they are generally grouped into 3 categories based on their terms: short, medium, and long. For instance, when it comes to U.S. Treasury securities, the bonds issued by the federal government, we have bills. These are short-term bonds of 1 to 5-year terms. Notes, these are mid-term bonds of 6 to 12-year terms. And bonds, these are long-term bonds of 12+ year terms. Short-term bonds offer lower interest because they are considered less risky, given that your money is invested for a shorter time. On the flip side, long-term bonds are seen as riskier and therefore offer higher interest. Number 3, bonds are more affected by inflation. As we have seen, inflation happens when the prices of goods go up. When you lend money by purchasing bonds during inflation, the money you get back can buy fewer things. It loses its value. One crucial factor in deciding the interest rate for a bond is the expected inflation rate. Because some level of inflation is typically present in a thriving economy, it particularly influences long-term bonds. Number 2, bonds suffer more from credit downgrades and liquidity risk. Imagine you purchased a bond from a company with a AAA rating. There's a risk that later on the company faces difficulties and those rating agencies decide to lower its rating. As a result, the value of your bond decreases along with it. Certain companies are not very popular, and the same goes for their bonds. Liquidity risk comes into play when there's a chance that when you want to sell, many buyers won't be interested. Few buyers usually mean lower prices. One simple solution to managing these risks is to own a diverse bond index fund. Number 1, municipal bonds offer the best deal. Municipal bonds are bonds issued by governments and government agencies at the state and local levels. Typically, these fund public works projects like schools, airports, and sewer systems. While offering lower interest rates than corporate bonds, municipal bonds are exempt from federal income taxes. They are also generally exempt from state income taxes for the state in which they are issued. This makes them attractive to people in high income tax brackets, especially those living in states with high income taxes, as it reduces the cost of interest payments for the governments issuing these bonds. Vanguard, for instance, has several funds devoted to municipal bonds, including several focused on specific states in the United States. Now, if you want to get a free financial consultation and get expert advice on financial planning, retirement, and so on, head over to MoneyPickle using my link in the description, moneypickle.com/practicalwisdom. This is not sponsored, by the way. I just believe that a lot of you would benefit from the service they are offering. Plus, it's absolutely free. All you have to do is book a time you are free, and you are all set. Well, that's all for the video. Thanks for watching, and until next time, have a great day.